Okay, so we've got our final chapter that we're going to talk about, which is budgeting. And the title of this particular chapter is Budgeting for Planning and Control. And that's one of the reasons why budgeting is so important. It does help communicate plans of the organization throughout the entire company. It helps coordinate activities so we can allocate funds and budget for certain things to happen. That's going to help us coordinate activities and define goals and objectives. It's also going to give us a way to evaluate performance because we'll have our budgeted amounts and we can then compare that to our actual amounts so we can see, did we meet our budget or did we exceed our budget? It just in general helps focus management and helps them think about and plan for the future since we have to allocate our resources going forward. It also creates again an early warning system. If we thought we were going to do 100,000 in sales and we're sitting at 50, the red lights might start flashing and it might be time to take some corrective action before things get dire. So again, basic benefits of budgeting: requires managers to plan. It promotes good communication and coordination amongst all employees, and it does provide a benchmark for evaluating actual performance. So a budget is a financial plan that managers use to coordinate business activities. So managers use these budgets in fulfilling their major responsibilities. First, the strategies are developed, and then overall business goals, such as a goal to expand international operations or a goal to be a value leader in one market while diversifying in other markets. Companies then plan and budget for specific actions to go ahead and achieve those goals. So the next step then is to act, to carry out the plans. And then after acting, managers compare the actual results and use that information to make decisions. And then that feedback mechanism allows them to determine what, if any, corrective action needs to be taken. For example, if we need to spend more money in one area of operations, then managers often need to cut in other areas or increase revenues. And then the whole process starts all over. It's a loop. So the control step is not an end, but an input into developing strategies the next time around. So successful companies use current period results to help make decisions regarding the company's future. So how does the basic budgeting process start? Typically, for most companies, it starts based on past performance. So they can say, what did we do this time last year based on, what advertising we have going on, what kind of promotions we might have going on, what's the weather like this year, do we have any new products, what's the economy like. We can start planning for what our budget should look like this year, and that typically begins several months before the end of the year. We also can look at potential industry sales. So what's going on in our industry, how much does our company expect to share out of the total industry shares. There's also something called zero-based budgeting. So rather than looking at historical data and maybe rolling that into next year's budget and adding a 3 or 5% increase, zero-based budgeting means everyone starts from zero. So you have to justify each and every dollar that you're receiving or that you expect to earn, and it starts in that manner. So basic budgeting procedures do vary from company to company. Ideally, you get everyone involved because if employees have some say or buy-in into the budgeting process, they're more likely to be motivated and to try and put forth more effort and to make things happen. And here's a basic performance report for a service company. And you can see here we've got variances. So we will see, and this is for the month ended, this is an income statement, what the actual numbers were, and then what the budgeted numbers were, and then we'll see a variance. So in this case, revenue was $589,000 actual. We budgeted for $600,000. So that's $11,000 lower than what we budgeted, hence the negative variance there. Now for expenses, we had some expenses here that actually came in below budget. If you're below budget on expenses, that's actually a positive or a favorable variance, not an unfavorable variance, even though it's showing as a negative in this case. Contribution margin, unfortunately, again, an unfavorable variance because it's lower than what we budgeted for. And the operating income there, again, is less than what we anticipated. So how do managers motivate employees to accept the budget's goals? Well, like I said, if we get employee buy-in when we actually set our budget, that is certainly a good way to help get them to put forth more effort and be more motivated to actually support the budget. Also, managers need to show employees how budgets can help them achieve better results. So oftentimes bonuses and other things will be based on the budget. So again, if we can put that into perspective for them, hey, if we do 100,000 in sales and we're only budgeted for 8,000 or 80,000, then you may share in that extra profit. Here's something else that's really important. We want to set goals that are realistic and achievable. You don't want to set a goal so high that an employee is like, there's no reason for me to even try because I'll never reach that goal. It needs to be high, but definitely attainable. So you're pushing them slightly, but again, we don't want to make it too high that it's unrealistic or people will just give up. Here's a basic format of a participative budget. So we're going to get the budget prepared with the cooperation and participation of managers at all levels. So I really like a participative budget because you're asking people down in the trenches who are working with customers every day to go ahead and give their input, and they filter that up. Now, the advantages of a participative budget, and I've kind of talked to some of these already, that individuals at all levels of the organization are viewed as members of the team, so their judgments are valued by top management. The motivation then is generally higher when individuals participate in setting their own goals than when those goals are set from above. Those estimates prepared by those frontline managers are often more accurate than estimates prepared by top managers. And a manager who is not able to meet a budget imposed from above can claim that it was unrealistic. But if they're setting their own budgets, that makes it a little bit harder. Now, there's some negatives or disadvantages as well. It can be quite time consuming and costly to get everyone's input to generate this budget. Here's a big one too, and I'm sure you've all heard of this. We have something called budgetary slack. That's where people intentionally underestimate their revenues. So they know they can do 100,000 in revenue, but they're going to tell you they can only do 80. So they'll show up and they'll end up being a superstar. They've got a little cushion. The same thing goes with expenses. They tend to overestimate their expenses, so it's easier for them to meet. We also have a philosophy in some places, which is spend it or lose it. So it comes to the end of the budget year, people are afraid if they don't spend their entire budget, that next year it will get cut. And that's a really bad thing because people end up spending a bunch of money that they don't need to be spending. So it's better to incentivize your employees to, if they do save money, maybe share some of that savings back with them. So we have some basic human factors in budgeting. Obviously, management needs to be enthusiastic and committed to the budgeting process. Here's a good one. They must not use the budget to pressure employees or blame them when something goes wrong. This is sometimes hard to do because we do use it for an evaluation tool. Again, here's what we thought you should do. Here's what you actually did. Why the discrepancy if it's not a positive? And again, those highly achievable targets are much preferred to super high, unrealistic ones. So we have different types of budgets. We're going to talk about all of them: strategic and operational, static and flexible, and master budgets. So here's what a master budget looks like. A master budget starts with the sales budget. Sales budget drives all of these other budgets. So once we compile the sales budget, we can prepare the production budget. The production budget, will drive our direct materials budget, our direct labor budget, and our manufacturing overhead budgets. That will drive our cost of goods sold budget, our selling and administrative expense budgets, and filter right into our cash budget, which also takes into account any capital expenditures. Those drive our budgeted financial statements, the income statement, balance sheet, and statement of cash flows. So let's go ahead and start at the beginning with the sales budget. Again, this is the most important because it's going to drive all of our other budgets. So it's derived from management's best estimate of sales revenue for the budget period. And it's pretty straightforward in the way it's calculated. We just take the unit sales volume for each product and multiply that times the anticipated selling price. So here's some general factors we should consider in our sales forecasting. We take into account general economic conditions. Are we in a recessionary period? Are we in a really strong economy? Those are things that you want to take into account. What kinds of trends do we have in the industry? Is the industry trending up or down on sales? Is there any anticipated advertising or promotions that we should take into account? What's our previous market share, price changes, technological developments? You can take into account all sorts of information when preparing your sales budget. So here's an example. Royal Company is preparing budgets for the quarter ending June 30th. Their budgeted sales for the next 5 months are $20,000 in April, $50,000 in May, $30,000 June, $25,000 July, and $15,000 in August. And I'm sorry, it's hard to see here. The sales price per unit is $10. So when we're calculating our sales budget, just take the budgeted sales in units times the unit sales price. That tells you in April we expect to sell $200,000 in revenues, $500,000 in May, $300,000 in June. Add those together, we'll get quarterly numbers. Now, once we have our sales budget, we can prepare our production budget. So the production budget is going to look at what are our budgeted sales units, then take into account what is our desired ending inventory. So a lot of companies like to keep a little cushion on hand at the end of the month or the end of the period to make sure if they have any sales fluctuations that they do have a little cushion. So we'll add that desired ending inventory, ending finished goods inventory, and then we'll subtract any units that we had on hand at the beginning of the period, our beginning finished goods units, and that'll tell us what we actually need to prepare. So here we have the management at Royal Company who wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So on March 31st, if 4,000 units were on hand, let's take a look at how we would prepare the production budget. So 4,000 units will become their beginning inventory. And then remember, they want 20% of the following month's budgeted sales in units on hand at the end of the month. So here's our budgeted sales that comes right from our sales budget. And then our production budget, remember we want 20% of next month's number. So 50,000 times 20%, that means we want 10,000 units on hand at the end of the month. And so that means we need 30,000 units. Now I already had 4,000 on hand. That means I need to produce 26,000 units. Now this 26,000 will become the 10,000 will become my beginning inventory for the next month. Let me show you. So it says, what's the required production for May? And if we go down, we can see it's 46,000. That 10,000 ending inventory becomes my beginning inventory number for May. I need 20% of June, so that's 6,000 units. That will become my ending inventory for May and then my beginning for June. So add that to the budgeted sales units. That means I need 56,000. Subtract the beginning inventory of 10. I need to produce 46,000 units. And then we can go ahead and finish and complete that production budget. This 5,000 number is assumed because we don't have July's number in order to calculate that. So that's just a given. Okay. Once we prepare the production budget, then we can do our direct materials, direct labor, and overhead budgets. So when we're calculating our direct materials budget, this is going to tell us how much do we need to purchase during that particular period in direct materials. And it's very similar to what we did for the production budget. We're going to look at the direct material units required for production, and you can see we can calculate that by taking the required units of direct materials, multiply that times the anticipated cost per unit. Once we take our direct material units required for production, we can add that to the desired ending units. So again, do we want to have some extra cushion on hand at the end of the period? Subtract our beginning direct materials units. That'll tell us what our required material units are that need to be purchased. And then, sorry, that is where we get this number. The red transfers down here, the required units. Then we multiply times the cost to get a cost, a total cost. This is just another way to lay out that horizontal information I just gave you. Take the budgeted units to be produced times the cost per unit. That'll tell us the direct materials needed for production. Go ahead and add any desired ending inventory and then subtract the beginning inventory to get the budgeted purchases. So let's go back to Royal Company. And remember, they wanted 5 pounds of material required for production. 5 pounds of material required per unit of product. They want materials on hand at the end of each month equal to 10% of the following month's production. So that's my desired ending inventory. They have 13,000 pounds of material on hand at the beginning of the period. That will be my beginning inventory, and the cost is 40 cents per pound. Okay, so we've got from our production budget the number of units to be produced. And remember, it said just a second ago it takes 5 pounds to produce each unit. So that's telling us how much we need in pounds of each direct material, or of the type of direct material. Our desired ending inventory was 10% of the following month's production needs. So we can go ahead and fill that in, 10% of the following month's production needs. Add in then our beginning inventory. So in April, we need to purchase 140,000 units. Question then is, how much material should be purchased in May? Feel free to pause the video and work it out on your own. I'm going to go ahead and skip to the answer here. It's 221,500. The way we got that, again, take the required production times the 5 pounds per unit. Says we need 230,000 pounds. We need 10% in ending inventory of the next month's production needs. That tells us the total needed minus our beginning inventory, which happens to be the ending inventory from the previous month. We need then to purchase $221,500 worth of materials in May. And once again, we can go ahead and complete the direct materials budget for the quarter. Again, assuming an ending inventory since we're not giving July's numbers. Once we have the direct materials budget, we can calculate the direct labor budget. The way the direct labor budget is calculated, we take the units to be produced, multiply that times the direct labor time per unit, and then multiply that times the direct labor cost per hour. Multiply all three of those components together to get the total direct labor cost. So here's an example, and this is a little bit of a wonky example. I can see why they do it, but let me explain it to you. So in this particular example at Royal, each unit of product requires 0.05 hours or 3 minutes of direct labor. This is what's wonky. The company has a no layoff policy, so all employees will be paid for 40 hours of work each week. In exchange for the no layoff policy, workers agree to a wage rate of $10 per hour regardless of the hours worked. So there's no overtime pay. That's why the problem is a little wonky, just to simplify things without taking into account overtime. So for the next 3 months, the direct labor workforce will be paid for a minimum of 1,500 hours per month. Trust me, you won't have any problems just like this, but hopefully you can get an idea or feel for the process. Again, we look at our production budget, tell us how many units need to be produced. Remember, it takes 3 minutes to produce each unit, or 0.05 of an hour. This will tell us how many labor hours are going to be required for each month. Now remember that silly no layoff policy. We guarantee at least 1,500 hours to our employees. So even though we only need them for 1,300 hours in April, we will go ahead and pay them for 1,500. May is fine, 2,300, and then June again was a little low, so we'll bump that up. Multiply that times the $10 per hour. That'll give me my direct labor cost for each and every month. Add that together to get the quarterly rate.